Buffett looks across public markets and his 80+ portfolio set, and he can buy back his own stock. And he's sorting across a far more global superset of opportunities. So the Dairy Queen mini CFO never gets the check, but it helps the mothership and it helps allocate. And none of us can do that. Blackstone can't do that. Well, back to your earlier point around conviction is high in the world and really shouldn't be. It's a great point. That's another way of saying fade the consensus when it's highly convicted. It's a summary of how we open the conversation. 3 weeks ago, markets were pricing in an 80% expectation of a March Fed pivot. Now it's 63%. When consensus is that highly convicted and you got 3 months to go, can consensus get more convicted on that? No, they cannot. You don't have to do something all the time. You confuse action with value, and we know statistically people overtrade and they feel that dopamine pump. They must take an action, and usually it's against their own interests. I think investing in distressed commercial real estate is one of the best opportunities for long-term tax-efficient wealth creation. It's a Buffett-like play. You got to find a great manager, preferably in a tier 2 market, meaning avoid New York City. Why? Because you're gonna have competitive auctions for these trophy assets. Right.
The Markets Policy Partners began as kind of a private sector version of the Treasury Markets Room, essentially.
Oh, really excited to have Ram Ahluwalia on when he and I get together and talk about issues in the markets, investments, and macro and digital assets. There's just a whole lot of fun about the conversation, and our readership based in the financial markets who need to pay attention to government policy, and our government people that need to pay attention to financial markets. They're probably not going to be accustomed to the unusual depth that you bring, to the unusual breadth that you bring to topics and conversations. So I'm really looking forward to our conversation here. Ram, why don't you explain a little bit about what you do and how you look at the world, and then we'll talk about the overall markets, and then we'll talk about themes and a whole lot of different things.
Let's dig in. First off, thank you for having me. I always enjoy our conversations as well, especially the depth of history and putting perspective around some of these concepts, which I'm sure we'll get into as well, and the evolution of how investing has evolved. There's a lot we can talk about. So I'm the founder and CIO of Lumida Wealth. We're a private wealth management firm. We deliver endowment-style investing for high net worth and ultra high net worth individuals. That includes investing in alternative assets that might range from distressed commercial real estate to long-short biotech funds to digital assets, as well as public equities, where we have different thematic views we apply. So the basic insight was, after I exited my prior company, Pure IQ, I sold that. It's a startup, sold it to an A16Z-backed bank called Cross River. I just couldn't find good wealth management. Like, if I know more than the person, the guy on the other side of the investment desk, then that's a concern. You know, I couldn't get good opportunities. They were always recommending these big hedge funds, which are more asset gatherers rather than niche capacity constrained strategies that actually deliver real value added. And so I wanted to, access the kinds of return and risk profiles like a Harvard management company or Yale endowment can produce. That's what endowment style investing is. And we blend that with trust, tax, and estate planning. So how do you get the best of investing with the best of trust, tax, and estate and service? So I don't have to deal with K1 collection, which is a pain in the butt if you're doing private investments. And I can have people track and manage all that, so I can focus on my life and get time back. That was really the thesis of Lumida Wealth.
Well, from what I urge everybody to follow him on Twitter. It seems it's hard to know that you could keep a job and a family life going with how much good quality content you put out on Twitter.
Only two things: it's work and family, and we're having either way. Work is play. If you love what you do, as Steve Jobs said, you'll enjoy doing it, and you'll do great things with it. And we have a newsletter as well on Lumida Wealth. You can check it out. We publish it every Sunday, which is a synthesis of what we've been focused on over the week.
And it's excellent also. Ram, tell us a little bit about your investment approach. It's and the idea of non-consensus investing.
Sure, sure. So, our headline approach is, especially in public equities where this really matters, is non-consensus investing. Also matters in private markets. We'll come back to that too. So what's non-consensus investing? The interesting about non-consensus is that it's content neutral. It starts with the word not. And then the second term is consensus. So it says not consensus. So most of the best investments and themes over the last 10 years have generally been non-consensus. Look at this past year. If you bought JP Morgan during the bank crisis of March and April, you're at all-time highs right now. We did that, wrote about that on Twitter. If you bought uranium the first half of this year, even through September, you did very well. And a lot of ways to approach that. Now you're seeing a lot more discussion on uranium. It's still not consensus, becoming more and more consensus, right? Last year at this time, there's a discussion of hard landing and the need for a Fed pivot. And the hedge fund short interest in the market was at the 99th percentile. It was crowded consensus short. And if you faded that, meaning you did not bet on a pivot, that was one of the best trades of last year. Not betting on the Fed pivot and going long risk assets because they were priced in. So that's the premise of non-consensus investing. It's saying, instead of trying to forecast a year from now, no one can forecast. It's a dynamic world, it's a market economy, it's always adjusting. We had the most telegraphed recession last year. People adjusted, corporates adjusted their behavior, consumers adjusted their behavior, households adjusted their behavior. So something else happens. So rather than trying to be an equity strategist, look at a year ahead and say, here's what I think is going to happen. Instead, look at what's right in front of your face. What is consensus? Where am I today? And guess what? That's an easier task. It's an easier task than trying to predict a bank crisis, which no one could have foresaw coming last year. Or the AI narrative, which developed last year as well. It's better to look at what's in front of me now. Even that's hard too. Looking at, well, what is consensus?
That was always, having been in the markets my whole life, you can kind of generally sense it. You can definitely sense it when it's gone a while, but you don't know how much is left, and it's not so simple.
It's not
but
simple.
It's easier than guessing what
it's a more tractable problem. And then once you know what consensus is, here's the idea. If you are at an extreme, what are your extremes? Hard landing, say soft landing. You can't get more movement than those. There's no soft landing for longer idea. Soft landing is Goldilocks. You can't improve upon that. So if that's consensus, and consensus is expressed in market prices, so you can look at credit spreads, look at high yield, you can look at valuations. And then of course you can look at social indicators like you go to the newspaper rack at the airport and you see what people are talking about. Last year at this time it was
Google search words.
Google search words are great, right? So then if that's consensus, you know that it's not a stable equilibrium. What you know about markets is that they move from one equilibrium to another. I kind of liken it to a metaphor of, there's Mr. Market. We know this from, Benjamin Graham, intelligent investor. And Mr. Market is emotional. Mr. Graham gets excited, gets depressed. When Mr. Market spits out expensive prices, we want to sell. When the prices are low, we want to buy. That's easier said than done. You have to know where is consensus. And once you've identified consensus and it's fully baked in, it's not transitioning towards consensus. When it's fully baked in, then you know that's not a stable equilibrium. And that is when you reposition. That's what we did actually over the last 2 weeks. And I shared the buildup of that progression, on Twitter. And then in this last newsletter, we talked about that again. And then at Tuesday at high noon, we said, all right, we're repositioning and we're taking action now. So that's how you can approach this non-consensus investing philosophy.
Well, I'll spoil the great metaphor for those who haven't read it yet, but the Tarzan analogy is a great one.
It's a great one. It's a great analogy, right? So the Tarzan idea, Tarzan is, I guess you could call Mr. Market. Tarzan is jumping from vine to vine, and a vine is a pendulum. It starts neutral. There's no narrative. And then you start to see consensus start to build, start to get momentum. And when it's at a peak, for example, Fed pivot can't get any better than that. It's going to start to decline. And Mr. Market's already moving on to the next vine. A good example more recently would be the December Fed press conference. People walked out of that saying, oh, we're going to have Fed rate cuts sooner. And markets lifted off. And I was on that call too. I said, it's not my rate. It's not what I heard. And of course, all of last year, people expecting Fed rate cuts. Markets are notorious about misreading the Fed. We've probably all seen that chart where you have the dotted lines expecting rates to move in one direction and markets just keep going, or the actual realized rate path, policy path goes another direction, right? And now that's starting to come undone, right? The probabilities for rate cuts are starting to diminish. That's a classic recent example of that. So yeah, Mr.
Another great example was in 2019, at the end of that 20% sell-off in the equity markets for the Fed trying to tighten. Maybe it was the January 2019. Was it end of 2018 or 19? Whatever it was. The Fed, I listened to that conference call, which was such a key one. Everyone was thinking that they might get easy again. And I listened to it and the markets took off and I said, I didn't hear him say that.
Right on. So the key here is this. This is the big philosophical point to make. It's not about being right or being wrong or saying this is what will happen and having a crystal ball. That's not it. Example, 2011, we had the European debt crisis. The US government bonds were downgraded by S&P in the summer. And in October, the economists came out and said we're going to have a recession. Okay, that was consensus. So, but there was priced at that point in time as well when it became consensus. That's the key idea. The challenge is the pendulum, the vine moving and transitioning from one equilibrium. That's the hard part, navigating the turn in the road. But that's the idea. So, and markets did well in 2012. So identifying consensus is what you want to do. It's not about will there be a recession? That's the wrong way to think about it, right?
No.
Because you never get there. You never get to the destination because you're always having new information that's looking out a quarter ahead or a year ahead. You're always transitioning from one narrative or equilibrium or consensus expectation to another. It's not as if we say at the end of the year, we're done now, markets are done. Now we're going to award the prize of who got it right. That never happens. We're always discounting the future.
Also, there are lots of issues where you have a consensus, not consensus, particularly as you get into individual investment themes, that give that allow it to be an interesting analysis because there are different things you can take action on. What are some of those right now that you're seeing? What are some of the themes where a non-consensus approach seems to be the light you're able to grab the next vine?
Yeah, I'd say there are long-term themes and short-term themes. So a long-term theme for secular investing, meaning I like finding 10-year plus trends that have a secular thesis behind them that I can reliably bet on. Semiconductors is a good example of that, right? In AI, people are throwing money at ChatGPT, $86 billion valuation and $1 billion in revenue. Mind you, when Google went public, they were profitable. PE ratio was like 30. Forget about price to sales, 86 to 1. So there's a lot of focus on AI, and in private markets, those companies are extremely valued. In public markets, you have high valuations on some of these names too. But a better move is betting on picks and shovels and infrastructure, and they're a lot cheaper. And NVIDIA is an obvious name, and NVIDIA is becoming more and more consensus. But it's got a cheaper forward PE than Apple, which isn't growing. In fact, they're shrinking their revenues. The year-over-year earnings is less than 1%. So that semiconductor layer is a non-consensus way to bet on AI, as opposed to paying nosebleed valuations in the application. I kind of liken it to search engine wars, right? Google was the 18th search engine to come on the scene, and then it dominated the market with one technical innovation called PageRank.
Yep.
Excite, Lycos, AltaVista gone, Yahoo gone, for all intents and purposes. So, you know, the animal spirits try to focus early and bet on these things and write them up. And meanwhile, you know, you want to be the monk in the mountain that's taking a step back and looking at another non-consensus way to approach the opportunity. That's one thing, semiconductors. Another is, look, I think energy. I think old energy as well. I think the ESG movement has made owning energy unpalatable, and it's under-owned. And you can see that in the valuations. These are companies with clean balance sheets or compounding earnings. And what I like about energy as well, like energy is a new bonds, right? Bonds and stocks are now positively correlated. Bonds no longer provide the diversification that used to mean if stocks dropped, bonds would go up. Now we're moving in tandem. That's not good from a diversification perspective. And you got elevated inflation. Inflation kills returns from bonds. Energy has emerged as a negatively correlated asset to technology. So I have thesis one, semiconductors. Thesis two, energy. What I like about that is I have a natural hedge with my energy. And mostly hedges you pay for. You have a negative carry, you pay a premium. You expect to lose money in a hedge. Energy's got positive carry and positive expectations.
Well, and energy, what's interesting about energy is that the same thing that's scaring investors away from it is scaring capital deployment away from it as well. And you've got a classic supply-demand commodity that if the supply is going to be constrained by a lack of capital expenditure, then you're going to get a favorable supply-demand for quite a while, since this has been a long trend.
You nailed it, Bob. Exactly. When capital is scarce and where it's rewarded and treated well, that's where it thrives. When capital being thrown around in the AI application layer, it's not going to be rewarded very well. Another theme is consumer staples. So, you know, the rise of the GLP-1s, we were long Novo Nordisk. We like that. It's extended and overbought right now, but we like that. We think GLPs are real. It's a big trend that'll go on for the next 10 years. But the rise of these GLP-1s created a narrative. Again, Mr. Market, manic depressive. Mr. Market got depressed on consumer staples. Hershey's, which is all the characteristics of a Buffett company, it's a confectionery, it's a chocolatier you can get daily habit around. It's like a See's candy, but better, arguably. You know, the PE trailing at forward dropped to 18.5. The last time we saw that, the stock went up 50% in the following year. Now, I'm not saying that'll happen this time because revenue growth is slower than it was then, but it's still attractive. It's a great iconic brand. It's alongside the brands of Nike and Coca-Cola. It's at that caliber. And they can acquire and distribute. Their earnings call, management commented how they contemplating doing share buybacks with the excess cash flow they have over and above the dividend, which they can raise. So I like that. You catalyst, but consumer staples happen to be cheap right now. So I think it's an interesting area to look at. You know, there are a lot of themes I'm looking at too in blockchain and crypto and tokenization. I think there's some interesting longer term opportunities there as well. You know, if you've got the right time horizon. I think another theme is aging demographics. People are living longer. So we invest in that theme in a lot of different ways. In Japan, there are nursing homes we own. There are small caps in the United States that we own. Second is biotech. Biotech is related to the aging demographics theme because people want to spend more to live longer. You know, people spend a lot of money on their dogs for veterinarian care. They're spending a lot more money on themselves, and insurance is also helping to foot the bill here, right? Biotech is a great thesis and a great theme. Biotech's gone nowhere for 3 years. The valuations up until the last month or two were at 10-year lows. You had a lot of assets at net cash assets, many of which would probably go to zero, by the way. It's the nature of biotech. It's like lottery tickets. But set against that, you have pharma, which has seen their IP expire over the back half of this decade, meaning most of their products can go generic. They're going to face generic competition. So they have to acquire and do M&A to acquire these biotech firms. And other key trend within biotech is that we've evolved from pure molecule discovery, like a molecule might be like Lipitor, let's say. We have new modalities coming online. mRNA is one. Of course, Moderna is built on this one modality called mRNA. New treatments are coming online as well. There's actually some promising signs being able to address Alzheimer's. That's incredible. I've never seen that before. So biotech is starting to deliver on the results from 20 years ago. The 20-year story in the making. Remember, Craig Venter sequenced the genome. Biotech had a dramatic boom and a bust. There was no delivery. .coms are the same thing. Boom, bust, no delivery till Web 2 started to come along, right? Biotech, the delivery is happening now. And GLP-1 is one form of that delivery. So now you have the zeitgeist. This is consensus formation. That consensus formation is there in the GLP-1 pharma market, but the biotech market's not there. People are going to look under the hood and say, where's this innovation coming from? M&A is going to start going up. So biotech is one of my overweight ideas for this coming year.
Yeah, and it makes sense that the biotech sector has been down and out as the cost of money has been going up and up because their earnings are so far out in the future. But the R&D hasn't been slowing down except for the handful of those companies that ran out of money. And those technology developments find their way, the good ones, or will find their way into the financial economy. So the longer one of those bear markets happens, the much more likely it is you can find and invest broadly and find ways to make a lot of money.
I absolutely agree. And your point on the Fed and where rates are going to be going at some point, that favors biotech, which are long duration assets. They don't throw any cash flow. So that is another tailwind supporting that, and other things. We like small caps now too. Small caps have gone nowhere in 3 years, and they're cheap. You have PEs of 11 to 14. So when people talk about is the S&P overvalued or not, it's really a tale of two cities. You look at Mag 7 and all the rest. I think the equal weight S&P will do well next year. I think within that, small caps will do quite well. So we've been identifying great opportunities there.
Should we, I wouldn't mind, I'm pivoting a little bit to, you mentioned the Fed and where we are. I'd love to get your thoughts, and John, you too, on, where are we in a grander scheme of things? We've seen the market go crazy. I mean, both the bond rate skyrocket and collapse over the last 5 months has really been historic. Where does it all mean? Where are we going? What do you think the economy, what's good about the economy? What rates, what should the cost of money be? And what is it longer term in your view? And John, I know we've been talking about this a lot too.
That's a great question. So 2 ways to answer this. One way to answer this is, what is consensus? From an investing perspective, that's the right way to approach it. The other way to answer it is, what do I think will happen? Right? So consensus is inflation drops, and it's a Goldilocks economy, and that's priced in. So from an investing perspective, there are better opportunities on the other side of that view, I would say, right? That's the non-consensus approach to answering the question. I'm not actually, in that non-consensus approach, I'm not actually telling you the answer of, Ram, what do you think will happen? I'm not actually doing a crystal ball. But from an investing perspective, that view is mispriced. The view that there will be bumps in the road to slaying the dragon of inflation. Right? Now, my own view is that the economy is outperforming expectations. That's why we had a great rally last year. You can look at the Citibank Economic Surprise Index. Economy is stronger than economists had expected, and you saw that in the non-farm payrolls report this morning. However, it is gradually slowing down. Rate cuts are having an impact. Looking out a few months from now, we just have to reassess. I'm more in the reassess, continually reassess, rather than put a view out there and attach an ego to it, which is dangerous, right?
Yes.
Not even the Fed knows what they're going to do at the end of March.
It's scary.
I don't think anyone really. I think the humble approach is to say, we don't know, we have a hypothesis, and we reassess, We look for data to confirm or reject that hypothesis. But by and large, though, you look at, housing start activity, it's been robust, and the psychology from declining rates has been impactful. I was speaking to the CEO of a large mortgage lender, and he said, with rates going from 8 to 6% in mortgages, people are excited now. And I said, well, 6%, we were there a few months ago. What changed between now and then? He really made a really great point. He said, because the curve is bending down now, we're 6% on the way down, not on the way up. And people want to be in this right side of the trend. I thought that was incredibly insightful about what that means for psychology, animal spirits, and markets momentum.
I totally agree with the that relative to expectations, relative to consensus. Yeah, for our view coming into the year, I mean, there's an enormous amount of uncertainty. And when you have an enormous amount of uncertainty, looking at Fed fund futures pricing in like a 70% chance of a rate cut in March, that is the kind of stuff of conviction, right? And we think that conviction is going to be in short supply this year. And one of the big uncertainties, obviously, is, and when you were talking about the themes before, one of the things that struck me is, sitting in Washington, D.C., you see things through a policy lens, through a geostrategic lens. I wanted to ask you about how you see, the state of the world, geostrategy, and how those play in. You can create an investment thesis that is very excited about traditional energy, that has a pretty significant geostrategic component in it, and similarly with semiconductors, you can see that almost like a moonshot, right? I mean, it's like a national project to not just establish something in the U.S. And pour the potential for public money, or at least incentive structures to be pushing in that way, but also holding down competition overseas in China.
Right.
So those are just a few. But when we look at the state of the world and the troubling headlines and so forth, and this can obviously veer into we don't want to take sides in politics, but into the the political uncertainty as well. How do you put those in your in your process?
Great question. I want to double back to your earlier point around conviction is high in the world and it really shouldn't be. It's a great point. That's another way of saying fade the consensus when it's highly convicted. It's a summary of how we opened the conversation. 3 weeks ago, markets were pricing in an 80% expectation of a March Fed pivot. Now it's 63%. When consensus is that highly convicted and you got 3 months to go, can consensus get more convicted on that? No, they cannot, right? So that is, it's a great way of framing that, fading consensus. So when consensus is at an extreme, sometimes consensus is correct, right? If we have 2 weeks to go before the Fed announces their decision, I'm going with consensus. If the market says there's a 95% chance of a rate cut in the FOMC meetings tomorrow, I'm going to bet on that 90% chance probability, right? So you don't want to be non-consensus for the sake of being non-consensus. That's a mistake too. Consensus can be right. Mag 7 was a good consensus bet, actually. But you got to have the perspective around it. It was a good consensus bet within public equities. However, at the meta level, public equities were 99th percentile short. So non-consensus at another level. All right. Now, to your point, John, on geopolitics, really interesting question, right? So I go back to energy. I think energy is a hedge against geopolitical risk. What happens when there's a geopolitical crisis? Oil prices go up. What happened when Ukraine invaded, or was invaded by Russia? Oil prices go up. So energy stocks may benefit. It's not required that they benefit, but I have a natural hedge through my energy exposures. I think the other part is sometimes insurance is cheap. Insurance is very cheap in December, where you had implied volatility and the VIX was touching 12. It's at 14 now. It's still relatively cheap. That means you can buy cheap protection on positions, which is what we did. Now, insurance, as we all know, is a negative expected value. You expect to lose money on insurance. You buy house insurance and you expect not to make money on the house insurance. No one wants to see their house burned down, right? But if you believe that insurance is cheap and consensus is offsides, then that can be worthwhile. Another good geopolitical story is Israel, right? So on October 7th, the Israel stock market dropped for about 3 weeks. And we covered this week to week on Twitter. So we looked at 9/11, what happened there. What happened in 9/11 is exactly what played out in Israel. Stock market dropped 3-4 weeks, then capitulated and rallied. The best performing country sector ETF in all of November was Israel's ETF. So if geopolitical risk happens, you have to assess where you are in that and be wary of panicking. Hopefully you're positioned ahead of that with exposures that benefit, like energy. You're still going to take the whack on the portfolio because you're net long the world, right? But you have something that benefits, that buffers some of the volatility. And then you can reassess. There could be an opportunity from that geopolitical risk.
In my conversations, one of the big surprises that is not in the headlines in the national press, but is a big subject, is how little the markets reacted to what were really geopolitical earthquakes last year. So people were saying, "Wow, the recession never happened. Everybody's predicting a recession." And the market didn't go down even though these big geopolitical risks materialized. And so I think there's a growing consensus, or complacence is a better word, that these geopolitical events just don't matter to the U.S. economy. They just don't matter to markets. And that may be one of the big surprises over the next couple of years, if any of this stuff becomes
really interesting question. It's one of these left tail risks that hangs over a cloud over your investing. And it's hard to hedge and hard to manage, but you have to be conscious and aware of it. And the 3 biggest ones are China, Taiwan, Russia, Ukraine, and Southern Israel. Now, I think the first 2 are the more critical in nature, although we'll see what happens during escalation, obviously, with Iran and the Houthis and all the rest. But if you look at China, the stock market's gone nowhere, it's been pummeled. So you could say that to some extent, that risk has been priced into China, although I think a lot of that has been the reshoring effect, which has hurt the Chinese economy, right? They have declining foreign direct investment. We've seen that since 1998, the levels there. So it's a really interesting tail risk question. I think the other tail risk question is around liquidity risk, especially in the treasury market, especially the decline of the reverse repo facility. So I'm not really worried about credit risk, consumer credit risk, or rising delinquencies, or even corporate credit risk. Corporates have gone bankrupt, like WeWork. Others will go bankrupt. That's fine. Airlines go bankrupt every 10 years. It happens. But liquidity risk is something to focus on, given all the machinations the Fed and the Treasury have done with these experiments of interest on excess reserves and quantitative easing and the reverse repo facility. These facilities didn't exist 10 years ago. This is new. Central banking is less than 100 years old, and now these inventions are they're young. We don't really understand. I don't think any human mind can fully comprehend in one mental picture the interactions of all of these. It's not possible. I think it's an act of ego. People will say they can. I think if you're humble and honest, you'll say, yeah, it's complicated. Like long-term capital management, right? You had the smartest people in the room from Goldman Sachs and Nobel laureates working on this. And we have the financial model that predicts and controls the risk, and we're hedged out. And we can look at the tail risk and manage this, and it did not work.
Who, us, worry?
Yeah, exactly, right? So that is a, intuition and Trump's left brain, pure deductive reasoning. You have to check the mental frameworks, which will be falsified by the market at some point. The market will do what it wants to do, and it'll break those frameworks. And I go back to non-consensus investing. If axiom number 1 is not X and it's content free, you don't have an ideology to blow up.
One of the things that is consensus, coming into this I hate to bring it back to Washington, D.C., but the election cycle. So if, we saw this very troubling. You mentioned the liquidity in treasuries, and it is something that, obviously the Treasury Department is never going to publicly state that, that they are, deeply concerned about this, but behind closed doors, I guarantee you they are working this problem and trying to get their arms around it. It's not something that you're going to see in the public, but the question of deficits and that October moment where we saw term that it was, is this pricing in higher for longer, or is this a runaway term premium? Is this, is this the bond vigilantes coming back? And we saw the counter reaction in November. Obviously, there was a sense of great relief. Boy, okay, this isn't necessarily a bond vigilantism returning to the scene. It's more of, it was heartburn about the Fed and about the economy running too hot. But, it certainly got people's attention. And coming into this year, with the election, the candidates, whoever they are, we think we know, but when they get out onto the stage over the coming months, they're going to be talking about economic programs, and it is going to be, I think it's going to be potentially a very unusual circumstance in which you can certainly make the case that the Trump administration. I was in the Treasury Department for the Trump administration's first couple of years, and I worked very closely with Gary Cohn, and they had obviously a focus on cutting taxes, and they were successful in doing so. There's no indication that they have an economic program that they're going to be bringing to bear that is that different. I mean, when former President Trump talks about his economic plans, he talks about cutting taxes significantly. And we saw this interesting moment in kind of shocking moment in the UK, where you had Liz Truss coming in with a what was in other contexts would be a an acceptable and and even maybe a favorable economic plan that involved a lot of tax cuts, and but also some spending as well, the energy and so forth, but it was deemed fiscally irresponsible. And certainly if you have two candidates, let's say, I mean, the Biden administration, I don't know if this is the case. My expectation is it might be different. But if the Biden administration were saying, we're going to go great guns with another big, if you put us back in power, we're going to be, going great guns with another fiscal program. And on the other side, you got former President Trump saying, put me in, I'm going to slash taxes down to nothing. What's the bond market going to do? I mean, if it's like, it's caught between rock and a hard place in that kind of circumstance. I'm not saying that that's where we're going to come down, but the kind of classic formulation, the easy formulation is Democrats not so big Democrat win, not so great for markets. Big Republican win, great for markets. And I think that mental model is coming under challenge under the current circumstances.
I would say like gridlock is good for markets. Statistically, that's the case. You get a divided executive and divided Congress, nothing gets done, even though things should get done. Gridlock is going to be best, but I would expect, to your point, John, is that we have increased risk aversion given the uncertainty and the different paths of policy that will be gyrating back and forth from now and year end. Increased risk aversion means volatility in markets, right? Now, post-election, I expect that to subside, right? Now, recall when Trump was elected, what happened? That day, markets tanked. And then what happened? They took off. So the mistake someone can make, if people get passionate about politics, they get passionate about sports, especially the I'm going to move to Canada crowd, happens every cycle, is that the other person gets elected and you make a bad decision with your portfolio. Do not make that mistake. American institutions have a long history and they will continue to do fine. They've been bruised. They need to be renovated. We need better leadership. I'm not making a political comment. They're just all of the above, right? But so yeah, I expect increased volatility to your point, because you're going to have diverging policy paths and you discount both paths forward and markets get confused, right? But on the other side of the election, I think we closed the year higher. You know, election years are bullish years statistically as well. I think we are in a bull market. So, you know, you just wanna, this is a time where you gotta be tactical. The 2010s, you didn't have to be tactical. Buy the index and go home and, you know, hang out, barbecue, right? This is a very different environment. There's, to your point, there's legitimate higher level of uncertainty on where we're gonna go today, right? Larry Summers posted an inflation chart overlaying the current experience of the 1970s. And what it shows in the 1970s was a spike in inflation around 73, 74, then it declined rapidly, just like we had today. And what he says is, look, we can't be sure that we've slayed the dragon of inflation. And the reality is no one really knows. Everyone's got a view, everyone's got a theory. What we know is that Mr. Market will get manic depressive and go back and forth on those views. Mr. Market's going from one equilibrium to another. So
It's
fade
very
the
true.
consensus is the move.
Ram, let's talk for a little bit about the great investor that always bet on the US government publicly, Warren Buffett. We talked about him a while and you've written about him, but I always viewed a big portion of his success was just never selling anything, so never paying the taxes that normal portfolio managers have to pay. And undoubtedly that's contributed some, but I love the way you looked at how he built his business. Tell us about that.
Tax is a crucial aspect to Buffett's strategy, to your point. Now, there are other pillars of the strategy, namely capital allocation and having proprietary investment opportunities that are off market, other levers, ability to borrow AAA rated debt and get a deduction. There are a lot of levers he has, but they all work together harmoniously. Tax is a big one, though. Buffett knows tax. So, you know, when he acquires a company, he loves brands. Guess what? If you buy a company for more than its book value, it's called goodwill. You can amortize and deduct the goodwill. That means less taxes. If you're using leverage, which he uses, he gets cheap leverage, AAA, you get a deduction on the interest expense. By the way, when you acquire a company, you get to amortize, depreciate the cost of acquisition, another tax deduction. If you never sell, you don't pay capital gains. He's very conscious about tax, absolutely, highly conscious about tax. So the other point you raised though around tax is related to the idea of finding businesses of a long duration of cash flow. So one of the questions is, why did Buffett never sell Coke in the late 90s? Great puzzle. Markets had lifted off. Buffett had bought Coke for about a 16 PE ratio in the 80s. Now, during the Nifty 50 era, Coca-Cola had a stratospheric valuation. It was way too expensive. It was consensus. Now, Buffett knew Coke then, and clearly he was stalking this investment. Great brand, consumer staple, habit forming, dopamine pumping, low dollar price. You can pass inflation through, all the criteria that Buffett looked for. Operating leverage, right? Small increases in revenue deliver a disproportionate return on earnings, right? Well, I believe the answer has to do with twofold. He was actually answered this question at one of his conferences. And he said he wanted the dividends from Coca-Cola. And he expected those dividends to continue for the next several decades. And that was his answer. Now, I don't know if he was right or wrong in that. Arguably, he was wrong. Maybe he should have sold Coke. But that was Buffett's answer. And I think it's interesting. I think about that decision he made at that point in time often. Like, was that the right decision or not? Now, the presumption is we should humble ourselves at the altar of Munger and Buffett and just adopt their axioms, right? Although, like, the left brain, analytical brain says, you should have sold Coca-Cola, recycle that somewhere else. But then what's the opportunity cost of capital? The other part Buffett will say is, well, there's nothing for me to do. What am I going to buy? And then maybe he could buy back his own stock. You know,
He's a spread investor, and he was making, it didn't matter that he could sell something and grab that excess economic rent.
he's a spread investor. Exactly right.
And he just had spread. If I go out 50 years, it doesn't matter if it's up or down in the near term. That's not one of the brands that would ever, you know, erode enough to hurt.
What Buffett is doing, if I put it in CFA terms, is he's doing levered carry trades, which sounds scary. You're not supposed to do carry trades. Carry trades when you borrow short, lend long, like you're trading Japanese yen against US dollar spot. He's doing levered carry trades, but with permanent financing and permanent capital, so they can never come undone. And that permanent capital is another edge he has over Blackstone. Blackstone's got to sell their prized assets every 10 years to create distributions for their LPs. Buffett doesn't have to do that. He keeps compounding. And he can do off-market deals quickly. Blackstone didn't have a private equity fund lined up to rescue the banks. It takes a year to market that. Meanwhile, your LPs have a drawdown. They don't have the capital to give you. Buffett's ready to roll. Buffett is a non-consensus investor. He likes dislocation, just like I do as well. He was buying the banks in a way. And Buffett, say the other comment about him is that most of the time he's doing nothing. He's reading a lot. He's like the duck in the water. Underneath there's a lot happening. He's reading a lot, but his action space is actually very limited. He waits for those moments of opportunity, then he strikes. And that's, by the way, a very similar behavior pattern as George Soros. Soros would play tennis, read a lot, and then maybe it was a quarter, maybe it was a month, maybe 6 months would go by. He'd come in the office and fire off a flurry of different trades, and that's it. And this goes back to the point Bobby, you and I were talking about when we had lunch, is waiting for the fat pitch. You don't have to do something all the time. You confuse action with value, and we know statistically people overtrade, and they feel that dopamine pump. They must take an action, and usually it's against their own interests.
FOMO both ways, buy and sell.
FOMO. So on that. Sorry, real quick. So FOMO, real quick, on this FOMO and there's FOPO. No one talks about FOPO. It's fear of other people's opinion. That's another one. Those are the two twin dangers. We all know FOMO.
Yeah.
FOPO, fear of other people's opinion. One of the interesting ways I generate ideas, I ask myself is, would I be most embarrassed to tell my friends that I invested in? Would I be most embarrassed to tell my friends I invested in? If you invested in crypto a year ago, it's embarrassing. My Twitter tagline was crypto CFA. I wore it like a champ. It's humbling. It's like Blaise Pascal wearing the steel coat that punishes you when you walk, so you just stay humble. It's like, you gotta wear it sometimes. Or buying distressed commercial real estate. Yeah, that's the move right now. So fear of other people's opinion is dangerous.
Well, there was one thing that you also pointed out about Warren Buffett that I thought was very insightful, and it also hits on the Coke idea, which is he's essentially a CFO. He has a portfolio of businesses, and he can starve some where it makes sense and invest their capital into one of his other subsidiaries. And you used a great example of that.
That's the number one principle. All these principles work in harmony. And the other part about Buffett is that he's a decentralized leader. He has incredibly competent operator managers running these businesses. And to your point, Bob, that mini CFO in that business says, here's my project schedule sorted by NPV. So Dairy Queen's like, let's go build 1,000 Dairy Queens because our return on capital is going to be 9.1%. And if they were independent, they would go do that. Buffett looks across public markets and his 80+ portfolio set, and he can buy back his own stock. And he's sorting across a far more global superset of opportunities. So the Dairy Queen mini CFO never gets the check, but it helps the mothership and it helps allocate. And none of us can do that. Blackstone can't do that. So Berkshire Hathaway has an investment model that is extraordinarily difficult to replicate because of that combination, that approach.
And at the end of the day, that really is probably the main thing that explains the long-term success that he's
Absolutely. I think look, he's obviously a value investor. That's a major driver of it as well, but it's more than that. People that say, oh, it's because he buys business with a moat and its value, it's 35 to 40% of it, but he's very deliberate about these other factors. He also looks for market leadership, #1 businesses too, which I look for as well. Coca-Cola, #1 brand. Wrigley's leader in the market. Goldman Sachs, leader in investment banking. Wells Fargo, leader in retail banking. Bank of America, also leader in mass market consumer banking. Market leaders. So one of the things we look for is find market leaders that are growing market share. If you can find a business that grow market share, then you may do better, because we observe in nature there are power laws in nature. Those are power law distributions. The number one takes the lion's share of the returns and the growth and the revenue. Number two, also, but not as much as number one, Pepsi's not Coke. And number three, what, DC Cola, where's that? Forget it, right? And that long tail is struggling for scraps. So market leadership matters, and he finds these dominant businesses like NetJets, leader.
You just mentioned crypto. That was your heritage. There is, it's been quite a good year for crypto overall. There has been a divergence of performance that you've written about, and love to get your thoughts on where we stand. I guess in my personal view, this Bitcoin ETF approval that seems imminent, but we will see, is a moment that will draw a lot of attention over time that I don't think the market generally understands well enough. But start. I don't mean to lead you. What's your thought on the world of crypto at this point?
I think there's short term and long term. Let's start with the long term, because that's what people should spend their time focusing. BlackRock ETF, I expect gets approved. It could even be this today at 4 p.m. Now, BlackRock is conferring no legitimacy to this asset class. It's more important than the flows into the asset class. BlackRock's the largest global asset manager. And Larry Fink is on CNBC and Fox Business talking about how Bitcoin is international money. And trust in institutions like central banks are on the decline, not just in the US, but also in impoverished countries where inflation is running away and where Bitcoin is finding use cases for international remittances or saving in Argentina or Lebanon, Iran, Russia, etc. Right? So yeah, the BlackRock development's a big deal. I think the story is primarily institutional right now, meaning the retail market isn't talking about it. You know, when I was home for Thanksgiving and Christmas, it was not the main focus. Maybe for me and a few others it was, but not broadly. It wasn't around the dinner table, which means that we're poised to have a new layer of capital enter the market, institutional capital. It'll take time though. It's not going to be like the next day. It's the difference between approval and then launching and then the marketing process. What's that? I expect we'll see a lot of Super Bowl ads. I want to count how many Super Bowl ads market this. There are 24 Bitcoin ETFs we're going to see, from BlackRock to Van Eck to Fidelity to ARK to Grayscale to Investor.
Bitwise has a really good presence in the RIA market.
Thank you. I didn't want to offend anyone. I started going out, I was like, shoot, who am I forgetting here? There's a lot.
Yeah, right.
21 shares. So there's a big marketing process. So they're going to educate the market and offer these products. And again, it's a power law. The winner of that race get the bulk of the AUM. So what's the incentive? Spend on marketing, heavy spend on marketing and sales.
And education.
That will introduce the next leg of the next layer of capital to enter the market.
Yeah, I think the other thing is the government endorsement of it through this approval will be particularly noteworthy because A, they've been so outspokenly against it, and
Right.
B, it's for those who want to do the work, it's the result of losing a court case in the most embarrassing fashion. The combination of that, for those who know it, it really it adds power to the endorsement, which is ironic given how much they don't want to endorse it.
Well, yeah, SEC Chair Gensler has lost 4 cases. Myself and the former SEC Chair Arthur Levitt, who's an investor in Lumida, we wrote an op-ed in the Wall Street Journal critiquing Gary Gensler, Chair Gary Gensler, in October, the bottom of the crypto lows. And I remember I had lunch with Arthur in May this past year. I said, Arthur, what's your biggest non-consensus bet? And he said, crypto will see financial markets sooner than later. And he's right. what a call, Arthur Levitt. So, yeah, no,
Respected.
by the way, I think tactically.
Wisdom.
Yeah, no, Arthur's incredible. Longest serving SEC chair, bipartisan, got stuff done, held Wall Street accountable, high integrity individual, non-political. I mean, he took a lot of grief for a lot of things and fought, entrenched and he's a model of a world-class noble citizen and regulator. But I would say tactically, I think this could be a buy rumor sell the news event. In fact, Bitcoin's trading down today. So when everyone's expecting all this money to show up and they realize, gee, you got to actually work the phones and do a bunch of marketing, there could be, I believe, sell the news event.
Absolutely. I mean, it's a fool's errand to guess how Bitcoin trades, in the near term.
Yes, and dollar strengthening now too. So that doesn't help Bitcoin right now. But look, there's a squiggle and there's a trend. Get the big trends right and you'll be okay.
That's right. Bitwise put out a survey of their RAs yesterday. I don't know if you happened to see it, but there were a lot of very interesting stats in there about adoption, where something like 50% of the brokers said that they have a lot of clients that own crypto on the side, and that only 11% of the RAs said they could buy crypto for their clients through their organization. And once an ETF is allowed, you not only have all this endorsement value, but now you have the capability of all these people. And they also said that only 12% of brokers had not been asked about crypto last year. And so they don't have to know anything. They don't have to be able to answer those questions. So a lot of RAs don't need, but going forward, if the incoming phone calls start picking up, you're gonna have a lot of people starting to do work on this that never have
I agree. I
has
think it'll
had-
be the legacy wealth management firms. I don't think are gonna offer these products. They don't today. They could offer us Grayscale products, but they're not. Or if they do, it's on a qualified basis. You gotta have 1 to 2 million minimum net worth, etc. It's the independent RIAs that could be the opportunity. So you gotta ask yourself, is there an incremental population that prefers the ETF that's not buying some of the existing closed-end product trust today? It's another way to look at it. I think the marketing is the bigger driver here more than the product format.
Yes, I
could go back and forth on that. It's an
exactly. It's not by a lot if it is, but the marketing seemed very, 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 very big. This is a lot of fees.
Yeah, it's interesting that the product format in Unlock is the fact that it's an ETF. And I love these Grayscale discounts. One of our best ideas this year was an ETHE, GBTC, getting these things at 40% discount. Now they've rallied and tightened dramatically. But that closing of the gap of that discount created another source of return. Now we're going to lose that, which is great. You want the discount to go away, so you sell at par. But those dislocation opportunities were
Well,
great.
we originally met on an afternoon at a conference that was diving into GBTC, which is the Grayscale Bitcoin Trust.
Right.
Let's take a few minutes on this because it really is a seminal product in the development of Bitcoin over history. And for people who don't know what it is, it's a closed-end fund that represented an ownership of Bitcoin that at the start is dollar for dollar. And then I guess the SEC actually required them to remove the redemption mechanism, or at least they chose to under guidance. And so eventually, when the bull market rolled over and all the hedge funds that had been gaming it, you can do the work on that or call me and I'll let you know what that was all about. But it went to a discount, and it got to as low as a 50% discount right around the time we met. And but tell me about what's happened now. Yesterday, it got to only a 6.7% discount, which is the smallest it's been since then. What's going to unfold, do you think?
Well,
Because you were I forgot to say, you were one of the experts on a panel discussing this.
Right. Thank you. Right. Well, the SEC, I expect, approves Bitcoin ETFs. That's step one. When that happens, that discount will tighten yet further, but it won't close till zero up until the Grayscale GBTC ETF is approved for ETF, because there's always a probability it's not approved, that's gotta be discounted, and there's a cost of money, that's gotta be discounted. So 6% is pretty tight. Maybe it gets to 5, maybe it gets to 4, but yeah, I think better opportunities aren't in the GBTC anymore. I would look at the Grayscale digital large cap product, GDLC, or Bitwise has a great product too. BIT, not financial advice, BITW, BITQ, and go look at the holdings of each one. But the point there is this, that the GDLC discount's like 35%, by the way. People aren't talking about that one. By the way, that product has rallied massively as well. You know what? Grayscale is a product for Solana. That one trades at a premium to par value, which makes no sense. Do not buy that because you're probably going to lose your money. Don't buy things that are worth more than the net asset value, which GBTC was 20–50% above NAV up until the Coinbase IPO. Then that premium collapsed and then went to ultimately a negative. So I think those are the rotations to make. I think the other theme to consider here, going back to the earlier question, Bob, is you're going to see mean reversion in the great rotation. And the market is going to focus on the Ethereum ETF next. And you could see an Ethereum ETF in May.
And that's because there already is an SEC approved Ethereum futures ETF.
Right.
And that was the premise, that was the underlying reason that the spot Bitcoin ETF is expected to be approved, because the court case showed that you can't approve, it's capricious and arbitrary to approve a futures ETF and not a spot Bitcoin ETF.
You gotta have consistent treatment. And Ethereum is a commodity in the eyes of the SEC. Solana is not, according to the lawsuit against Coinbase, not weighing in the merits of it. But Ethereum is a commodity that satisfies all the criteria that Bitcoin has. So when the Bitcoin ETF is approved, markets will focus on Ethereum. And knowing where markets will focus is answering the question, what vine will Tarzan jump to next?
Yep. Makes a lot of sense. How about where we stand in the grand scheme of things? What are some, one of the things that I think is a certainty is that governments of the world won't be able to pay off their debts. We've accumulated too much since the dollar left the gold connection in Bretton Woods in 1971, that mankind has done what mankind would do, which is borrow because there isn't a gating factor. And if this is all true, you would normally think that this is a very, very bad thing that will ultimately end in tears. And so it's very fashionable to think that today's not a good time to be living, because over the next period of time, we're going to have to confront this gigantic problem. So it's a little bit about prosperity. We have all this debt. How can our economy accommodate all of the pressures that we have that are building socially and politically, and are we in a good spot or a bad spot? So
yeah, it's a phenomenal question. There's a lot to unpack here. So yes, we're running wartime deficits and we're not in war. 2, the biggest driver of the deficit is entitlements. What is entitlements? Social Security, Medicare, and Medicaid. 3, politicians lack the courage to address those issues directly, because if you touch those issues, third rail topic, you don't get elected. So 4, the public has to wake up, especially Gen X, it's my generation, and say, I'm going to take it on the chin, cut my benefits. And the way to do that is through means testing. Means testing, they say, hey, look, if you generate X income above this threshold, you're not going to get these benefits, or your benefits are reduced. That is ultimately how they're going to have to address these entitlement issues. There's a path to resolution, is the point. What's that quote from Churchill? America makes the best decision when the back is against the wall at the very last possible moment. Something like that's going to happen. Maybe the bond market forces it. Who knows what forces it, but something like that will happen. It's already some discussion.
some economists, Lynn Alden in particular, talks about how this era looks much more like the 1940s than the 1970s. And what she was talking about is this twin gigantic deficits. One of the things about the 1940s that we don't appreciate is that the federal budget was cut by 75% after World War II. That does not seem possible.
Yeah, I don't see that's not politically possible because the
So we paid off the debt. We paid down the debt, and we resumed our ability to grow on an appropriate government capital base.
Right.
And that seems to not be one of the levers that we'll be able to pull in the future.
Here are the other levers on the growth side, right? There's expense cuts, then there's revenue. Obviously, one is like raise taxes. Like, first off, I'm all for lean, mean, efficient government, effective provision of services. Okay, so that's one. Mathematically, you're going to see some tax raises, probably. Statistically, it just seems to be the case. I'm not saying that's what I want to see happen. Okay. So plan for that. Trust tax and estate planning. Plan for that. Take steps now. The married couple lifetime exemptions at a peak right now. Take advantage of that. Get assets out of your estate. Avoid own tax efficient assets as well. Like real estate's a good example. Distressed commercial real estate, great opportunity. So here are the other levers. So one is productivity growth. Can we get the bailout from AI? We are seeing finally, after 15 years of languishing productivity growth, we're seeing a bump. I don't think it's even AI driven yet, by the way. I don't think AI is there yet, which is great because productivity is one of the only few free lunches. Productivity is really to create more output from the same set of inputs. So controlling for costs, you get more out for what you put in. So I don't think we're going to see AGI, the super intelligent AGI in the next 5-7 years. I hope I'm wrong. That'd be great. I hope it's benevolent. I kind of expect that, but that could be the bailout. We'll see. That's one. The other is integration, because part of this is the worker to retiree ratio of the people drawing on benefits versus contributing to the pie. And one of the factors that's gone unnoticed into why we seemingly have averted a recession in the last 12 months is that the US issued 1 million visas. And that helped to address the labor shortage and helped to address some of the labor inflation concerns, because wage inflation is the worst. That's when you get the wage price spiral. Goods inflation, it can handle, supply chains, they resolve. Wage inflation is the worst. So AI and immigration are different ways to solve for productivity, right? AI, as expressed through robotics, is a form of labor, arguably, you could say, right? So what does it mean for assets? High deficits and high inflation, real assets will benefit, they'll reprice. So if you own a real asset, you're going to reprice, meaning like bonds are not a good idea to own. I don't know why people own TLT. I have no idea why people own long-term treasury bonds. I can sort of understand short-term treasury bonds, but with the Fed cutting rates, you'll get a pickup on that. You'll get a capital gain from the rate cut, but you're talking about 13-week T-bill. Like treasuries don't make much sense at all here. And if inflation surprises, it's eating into your real return. People don't own enough stocks that act like bonds. They're long duration stocks that throw off high dividends, like Hershey's or Citibank or Barclays. Barclays has trades at a price to book ratio of 0.5. If you sold all of Barclays' buildings and assets, you get twice than the purchase price. That's what book value is. So investors need to orient towards what are called real assets. Real assets reprice for inflation, not in the short term, in the long run. In the short term, they get whacked. Equities get whacked with inflation because the market sees the hammer of Fed hikes coming. But ultimately, they reprice with inflation, right? If you deposit $1 million, if you doubled everyone's bank account, what would happen? Financial assets would double in price quickly. House price would double in price quickly. That's the intuition behind what I'm trying to convey here. Energy prices would double. Commodity prices would double. Food prices would double. And we'd all be in the same exact economic position, except for bondholders. Because bonds do not deliver a real return. Bonds deliver a nominal fixed coupon return. It doesn't get repriced. If you own real estate, your house is going to double in price. You're going to charge twice the rent. Real estate's going to do just fine.
we touched on, you mentioned real estate. The great disappearing headline from the fourth quarter of 2023 with the bond market rally was commercial real estate, which everyone was talking about as a consensus fear in the first half. What do you see in the commercial real estate market? Because I know that you look at it.
Yeah, so I think investing in distressed commercial real estate is one of the best opportunities for long-term tax-efficient wealth creation. It's a Buffett-like play. You got to find a great manager, preferably in a tier 2 market, meaning avoid New York City. Why? Because you're gonna have competitive auctions for these trophy assets that will get bid on by Blackstone, Apollo, and KKR, and that'll lead to a quote-unquote efficient return. You'll make money, but you're not gonna get outsized value. What you want to do is find a neglected, overlooked market like New Jersey, Jacksonville, Houston, Austin, where you've got good population growth dynamics, where the asset is fundamentally sound, meaning it's throwing off cash flow. It's in a great market. It's positioned appropriately. It's a Class A modern building, perhaps, or it can be repositioned as such, but the balance sheet's upside down, meaning it's got short-term floating rate debt and rates went up and they can't refinance and they're gonna blow up. See, the core issue
Because the local bank is under pressure because their bond portfolio did a certain
yeah,
thing.
they're cross-cutting effects. See, the local bank, I sat down with the chief lending officer of bank 6 months ago. I asked him this question: how do you feel about commercial real estate? This is what his response was. He said, "Oh, we're great because we're all floating rate risk. When rates go up, we don't have any hold to maturity issues," which felled 3 banks in the March-April crisis. So the banks are saying they're looking out for themselves. Like, I have floating rate risk. If rates go up, I'm not going to have a hold to maturity impairment. I said, you know, that means your borrowers are screwed. They're taking the other side of that. I, as the chief lending officer, bank, a smart individual too, by the way, right? Very capable individual. So there's more pain to come.
Well, I hope that he answered yes. You're right, but we underwrite these things knowing that we have some cushion there and that most of our businesses do still have the cash flows.
Yeah, no, by and large, most banks will be okay, to be clear.
Yeah.
But I think you'll see bank failures here and there. Look,
But the point is, your point is a good one, is whereas, the risk manager at a bank is looking at their own balance sheet, and the second derivative away may be the shock that they're not looking at.
Pain must be felt somewhere. Who's going to feel the pain in what order? The first person to feel the pain is the developers on the worst spot. So developers took out short-term construction financing loans as recently as a year and a half ago when rates were low, and then rates shot up. So developers in the worst possible position. The second are owners with floating rate risk, right? Or they have to refinance. They're in trouble. But if you have seasoned assets, you're okay. Doesn't matter. If you got long-term debt like Berkshire Hathaway, permanent financing, permanent capital, you're fine. By the way, that's most of commercial real estate. When we mean commercial real estate issues, we really mean like office, like industrial, transportation, logistics, all that's fine. The Amazon fulfillment facilities owned by private parties, that's fine. Data centers, it's fine. Commercial real estate's a small fraction.
Healthcare specialty, real estate.
Specialty, urgent care, that's fine. Malls are in trouble, right? Multifamily with that same kind of characteristic pattern I mentioned earlier, short-term financing, those are going to have issues. So there are workouts that are happening. If rates go down, especially the 10-year, that helps the banks reflate their balance sheet. If rates go up, I expect they'll go up. 3.8 is too low. We're at 4% now. I expect it goes higher. Settles between 4 to 5. Hurts the banks. Banks need time. So I expect the Fed to renew the bank funding facility in March. It's a 1-year term program. They got to renew that. So, but yeah, they incredible opportunities to distress CRE. You just got to find a good manager because real estate's hard. It's really hard. You got to be on the ground, local knowledge, have teams, have crews, know the permitting process. You got to be able to identify deals. You got to have seasoned managers. You got to have skin in the game, GPLP alignment. Manager sourcing is hard. So you can't just get the thesis right.
Yeah.
You have to get the expression right.
Well, my impression is that that's why there are so many numbers of people that are good at real estate, that there are a lot of people that have made their wealth in real estate.
There's an incredible amount of wealth creation, but people have no idea how much. You don't see them on the Forbes 100 list. There's a trio of families in Buffalo and Rochester These were immigrants that had blue collar jobs that like janitorial, etc. kind of work. And they saved a couple of bucks, they bought a small house, then they refinanced, they bought another in the early 80s, then they bought another. They own thousands of real estate in Rochester and Buffalo.
And even though you wouldn't think that those are, that's not a population growth center, it doesn't matter. You can
It
still.
doesn't matter. They generate a lot of current yield because it's not a population center, to your point. It's like a bond with a high current yield, but low price appreciation. And yeah, their kids are non-economic. They have extraordinary wealth through real estate. And you buy real estate, you go in every 10 years. This is one of those times when rates are high, you go buy real estate. It's a great time to go buy. You got to know what you're doing there. You have to be, again, you have to have skill and expertise. I prefer going through managers that have skill, track record, GPL, the one that diligence them too. Real estate's hard. There are also shady actors in real estate, like there are in crypto, like there is in biotech flipping. I mean, you got to get high integrity people that know what they're doing. So we do at Lumida, obviously. We invested with Kenny Passman, like founder of Knight Capital. He founded Knight Trading. He lives 30 minutes away from me. I've known him for 12 years. He is half of the fund. He's the biggest LP in the fund. There's alignment. And he's pre-funding the deals. I got to look through. I get to see every deal they've done before I put money in. So it's like a back to the future trade. And I buy in at cost after the assets already appreciated in some value, right? So those are the things that we look for, but you have to know what you're doing in this stuff. But it really is a great tax efficient long-term wealth creation. I'm going to get passive losses in that K1, which I want. That's not a cash flow event. And my K1 is going to say, Ram, you have a passive loss. We depreciated what we bought. That goes back to the Buffett strategy. Now I'm going to take that passive loss. I have a private credit strategy that I expect throws up 18 to 25% coupon every year, so that I sleep well at night and fund my lifestyle, and the rest is my aspirational growth bucket, right? Yeah. Now my psychology is secure. I'm not gonna panic because I have security, right? And guess what? That K1 of the private credit fund is called passive income. I pay taxes on that. The passive losses from the real estate offsets the passive income from private credit fund, and now I've solved for tax. And if I have a Roth IRA, which I do, I can put that in that vehicle because then I can pay ordinary income on that interest, coupon payments from the real estate.
Yeah, it makes a lot of sense. Well, Ram, this has been so much fun. I hope it has been for all of our viewers. And I hopefully everybody caught on that Lumida is the name of your firm. You want to just tell people how to find you?
Briefly, yeah, we're lumidawealth.com, LUMIDA, Lumida Wealth, and you can take a look at our newsletter there. You can subscribe. I'm also very active on Twitter at Ram Ahluwalia. That's a mouthful. RAMAHLUWALIA. And check out our research. We're a private wealth firm servicing high net worth, ultra net worth clients across asset class, endowment style investing. I invest in what we do. We love what we do. This is what we do. So we specialize in focusing, and we've had a fantastic year. And we take the responsibility of investing wealth for clients very seriously. We understand that means we have to be mindful of their dreams, their retirement plans, their kids' education, their philanthropic objectives, and minimize tax while we do it.
Awesome. Well, thanks so much. And for both of my partners at Markets Policy Partners, we're really happy we could have this time. And I do have another 5 subjects that I wanted to cover with you. So we'll do that. We would do another one.
This is a great pleasure, Bob. It's great. I always enjoy talking to you. It's such a great,
I know, it's great.
Far-ranging.
Thank you so much, Ram.
Thank you, Bob. Take care.
Take care. Have a great weekend.
You too. Be well.